Yo, what's up guys? It's your boy Looney. Today I want to challenge one of the oldest investing strategies out there. The idea that you can just buy and hold forever and you'll be set. Now, don't get me wrong, buy and hold is still a great strategy for the long term. But right now we are seeing a massive bullish momentum with higher volatility and also some unpredictable events. And I think it's worth taking a look at some other strategies like we're about to go over, such as called debit spreads and leap options. But before we get into this video, quick shout out to the Discord. It is free to join, and then I also offer a premium membership. It's $8 a month, and it gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links that are in the description. So let's actually break this down because buy and hold is a great strategy. And if we just look at it historically, it has made people wealthy for decades. If we look at just SPY on the max chart, it is up 300%. You can see the trend is upward. Sure, you do get pullbacks, but on a long period of time, and I believe this one goes back to 2000, so about 20-year stretch, it's historically goes up. And that's the core principle. But there is a problem with right now is the markets are moving fast and very quick, and we're seeing companies double in just months. So let's actually look at one like Robinhood. This one in the past year is up 400%. And then if we look at SoFi as well as another one that is doing phenomenal. This one past 3 months up 89%. A lot of different stocks are doing really good. Riot, another one, 73% past 3 months. You have Intel that got the news from NVIDIA investing, as well as NBIS also investing NVIDIA investing into them. It's kind of the NVIDIA effect, it seems like, but most stocks are violently going up. And I'm going to show you an example where call debit spreads come in, because let's say you don't feel comfortable actually buying shares at these price level, but you actually want to catch the upside direction, or at least the short-term upside direction, because you think SoFi is going to go up short-term, but eventually it might pull back, or you're waiting for an entry point. You could actually sell a call debit spread. You could also combine the two, which is what I'm doing. And I actually own 400 shares. But for me personally, I don't want to buy any more shares. I also have covered calls to hedge, but I also want to catch that upside. And that's why I set up a call debit spread. And the way it works is you sell a call at a higher strike price, and then you buy a call at a lower strike price. And let's actually look at the one I have open. So I have this on SoFi. I sold a $23 call, and then I bought a $21 call. And you can see there's 6 here because I have another strategy going on with them. But this is the call debit spread, and we'll set one up as well. But I need SoFi to stay above $22 by the expiration date 10/17, and I will make a profit. I could close early, which I'll probably do, but as of now, it is looking good. The direction looks good, and SoFi is very bullish. And if you want to set a trade up like this right now, it might not be the best time because, today SoFi absolutely ripped, and it went up 5%. Past month, it has been doing phenomenal. But the strategy that I'm using will actually do better than, or it should do better than what SoFi is actually performing. And although it is showing at 37%, I believe this one is just as much. I think it might be a little bit more, and you're using less capital to acquire those gains. But let's actually set one up. So if you go to view all options, say you want to go a little bit more than a month out, we can go to this October 31st, and you would choose a sell call, and then you would buy a call at a lower price. Sorry, I have it on buy. So we set this at sell, and then you want to buy a lower strike price right here, and it creates a call debit spread. And there's a couple ways to do it. You can do one that is in the money like I'm doing. The issue with that is you might get assigned early. And if you're doing this, you could also maybe look into a put credit spread, a very similar strategy, or not similar strategy, but a good alternative to this if you are nervous of early assignment, which could happen if you do in the money call debit spreads. And There's other ways to do it. You could do ones that are out of the money, and these ones are a little bit riskier, but higher risk, higher reward. I like to go in between the two, and let's actually set that up. So we would sell a call that is pretty much at the money. Right now, SoFi is at $29.50. So yeah, let's do one that is literally at the money. Let's do this 29.5 and then buy a call. You could do as much as you want, as low as you want. And this is kind of the cost. So it's going to cost you a max loss of $85, but really the cost is a difference between the strikes. So this is 1.5, so about $150. I like to go actually $2. So let's go down to this $27.50. And you can see here, max profit is 85, max loss is 115. And you could do as many contracts as you'd like. You could do 10. And you can see here that you can make a ton of money, $950, with only putting up $1,000, which is pretty insane. Let's say you put $1,000 into SoFi and you were looking to get $950. You basically need the stock to double in price. And with this strategy, you just need SoFi to stay above $28.55, which is already above that. So you can see here how this could actually help out with your returns. And that's why I'm mixing it in. I'm not going all in. I only have one contract doing this, but you can see that is actually helping my overall SoFi position. I'm not only collecting gains on the share appreciation, but also with these option strategies. I'm also doing it with Riot. I have one as well. Let me actually pull that one up too. So it is here. This one expires in November, so I still have some time, but I need Riot to stay above $16 and I should make a profit. You can see here, I'll make $178. I did 2 contracts, so this one I'm also excited about. And Riot, I'm up pretty big as well. I'm up 88%. Now, another thing I want to talk about is Leap options. This one's a little bit safer and it does take a lot more patience. And a Leap stands for long-term equity anticipation securities. And essentially, these are just long-dated call options, usually expiring a year or more out. And I really like this strategy. It lets me get exposure to the long-term growth of a stock at a fraction of the cost. So instead of buying, let's say, Riot right now, which was $17, you could actually buy a Leap call for a few $100. So let's actually look at that here. We'd want to go out about a year or more than a year, and that could be January 27. And you can see, instead of buying Riot for the prices right now, you could actually buy a call that is a little bit cheaper and it acts as if you own the shares. And I like to go 0.7 to 0.85 delta. So we could do somewhere in between, probably this $12 call that only costs $8.50 to do. And again, you do need Riot to go up. It's a bullish strategy, but it's long-term. And remember, long-term, the market generally goes up. Now, right now might not be the best time to do it, although we did see some rate cuts and there is probably a bullish going into these next few months, but it doesn't mean that it's going to happen. But this is a bull strategy and we are in a bull market. So momentum might be on your side. And also you can actually mix in covered calls against the Leap and essentially do a poor man's covered call, and you get premium as you ride the stock along. So I have Riot Leap call that I did a little bit ago. I did it in May, so I didn't time the bottom, but I'm already up 200% or $875, and it only costed me $400 to do this trade. Same with SoFi. This one I did not time good at all. I did it when SoFi was pretty high. It was like $15, and then it dropped to $10, and I just simply held through. And I'm up 1,300 or 170%, which is pretty crazy. You could also exercise this and essentially buy the shares at whatever strike price, or you could just sell these and acquire that profit. But you can see a long-term strategy. And also what you can do is if they start working against you, you could like double down. I know it's a little bit risky and it might be hard to do, or at least have the ego to do it. But that's what I'll do is if these start going red or a tough situation or some kind of fear in the market, I'll double down and actually buy more of these sort of plays. So why buy and hold might not be enough anymore. Because in a market this fast, you don't want to just be sitting on shares hoping they go up over 10 years. You want to be generating income and overall profit along the way. You could also hedge when volatility spikes by doing covered calls or selling puts. Selling options, another strategy that I use all the time. It is a great way to generate passive income. But you also want to be taking advantage of opportunities when they come. You can see we're in a bull market and there's a lot of bullish momentum. So you want to be buying these dips and perhaps doing option trading, which leverage even more. But they are risky. So these are the strategies that I like to use. I don't use them often, but I'm very strategic. Selling puts, running debit spreads, and adding leaps does give you that flexibility. So, of course, I'm not saying abandon buy and hold. I still have stocks and crypto that I'm holding for what I plan years. But I have learned that mixing in option strategies helps smooth out the ride, creates consistent cash flow, and lets me capitalize on both bull and bear markets as well. So the lesson is here. Don't just be a passive passenger in your portfolio. Be an active driver. Buy and hold works, but in today's market, buy, hold, and strategize might be a better path. Until next time, peace.